Hey everyone, welcome back to Corporate Decoder, the place where we break down the confusing world of business and finance to bring you the juicy details you actually care about. Today we are diving into Simmons First National Corporation's latest filing, a report that's all about how they've been funded recently, and let me tell you, it's got some interesting numbers. So buckle up because we're about to decode what this means for the bank and potentially for you. Simmons First National Corporation, a bank based in Arkansas, has just announced a pretty big financial move. They've completed a major public offering, basically selling off a chunk of their company to raise a significant amount of money. What's this all about? Well, they've offered $325 million in what they call fixed to floating rate subordinated notes. Now that sounds technical, but let's break it down. Think of it like this. They're borrowing money, but with a twist. These notes are subordinated, meaning if the bank runs into really serious trouble, other debts get paid back before these note holders. The fixed to floating part means the interest rate they pay starts at a set percentage and then will change later on based on market conditions. The very official document outlining this whole deal is the subordinated indenture. It's a contract between Simmons First National Corporation and a trustee, Wilmington Trust, that lays out all the rules for these notes. This is a pretty standard way for companies, especially banks, to raise capital. They filed all the necessary paperwork with the Securities and Exchange Commission, or SEC, making everything public. So Simmons First National Corporation offered $325 million worth of these notes, and they actually collected about $321 after covering all the fees and expenses that come with selling something like this. That's a significant amount of money. Now, what are they going to do with all this cash, you ask? Well, they plan to use this money along with some of their own cash to pay off an even older debt. Specifically, they are going to fully repay $330 million of their floating to fixed rate subordinated notes due 2028 on October 1st of this year. This is a pretty smart move. By issuing new debt, essentially refinancing their existing debt, they are likely getting better terms on managing their financial obligations more effectively. They also mention using some of the money for general corporate purposes, which is a catch-all term for anything else the company might need money for, like daily operations or new investments, say refinancing their existing debt. They are likely getting better terms or managing their financial obligations more effectively. They also mention using some of the money for general corporate purposes, which is a catch-all term for anything else the company might need money for, like daily operations or new investments. Let's talk a bit more about these new notes and how the interest works. For the first part of the loan, from now until October 1st, 2030, the interest rate is fixed at 6.25% per year. This means the interest payments will be predictable for the next few years. They'll pay this interest twice a year on April 1st and October 1st, starting in April 2026. After October 2030, the interest rate will switch to a floating rate. This means it will change based on a benchmark rate, which they expect to be the 3-month term as so far, plus an additional 3.02 basis points. That's like adding a fixed percentage on top of an already variable rate. This is where things can get a bit less predictable for the company, as interest payments could go up or down depending on market conditions. They also have a provision that if the benchmark rate goes below zero, it will be treated as zero, which is a common way to protect against negative interest rates. What else is in the contract? Well, Simmons First National Corporation has the option to buy back these notes before they are due. They can do this starting from October 1st, 2030, which is when the fixed rate period ends. They can buy back all of them or just some of them. They can also redeem them early if certain specific events happen, like if the bank gets into serious financial trouble. But this would be at set redemption prices outlined in the agreement. A really important point here is that if they decide to redeem these notes early, they will need permission from the Board of Governors of the Federal Reserve System, especially if it has to do with capital regulations. This is a key oversight to ensure the bank maintains a healthy financial standing. Now let's talk about the nature of these notes. They are unsecured and subordinated. Unsecured means there's no specific asset backing them up directly. If the company goes bankrupt, the people who lent the money through these notes are pretty far down the line to get their money back. They come after secured creditors and even general creditors. They are also subordinated, which means they are ranked lower in priority than other debts the company might have. This is a crucial point. These notes are structurally subordinated to all the debts and liabilities of its subsidiaries. This includes Simmons Bank itself and, importantly, the money it owes its depositors. This means if the bank's subsidiary, Simmons Bank, has problems, the holders of these notes are even further down the repayment line. Imagine a pyramid of debt. These note holders are near the bottom. The rules for when the maturity of these notes can be accelerated, meaning they have to be paid back sooner than planned, are very specific. It's basically tied to major bankruptcy or insolvency events for the company itself or its primary subsidiary Simmons Bank. They can't just speed up the payments if, for example, they miss an interest payment. This protects the company from having all its debt called in at once due to minor issues. The company also included an opinion from their legal counsel, Troutman Pepper Locke L. This is a formal statement from their lawyers saying that the issuance and sale of these notes are legally sound. It's like a stamp of approval from the legal department. This opinion is filed as an exhibit to the report, showing that all the legalities have been checked and are in order. This filing also falls under item 203 of these reports, which is about the creation of new financial obligations or arrangements that might not be directly on their balance sheet. Essentially, issuing these notes creates a new direct financial obligation for the company. Like most major corporate filings, there's a section dedicated to forward-looking statements. This is where the company talks about potential future events, like their plans to use the proceeds from this offering. They use words like anticipate, expect, and intend. It's important to understand this is not a guarantee of what will happen. They're essentially saying this is what we plan, but there are always risks and uncertainties that could change those plans. They're very clear that these forward-looking statements are based on assumptions and that real-world risks could cause the actual results to be quite different from what they are predicting. This is standard practice to manage expectations and avoid potential legal issues if things don't go as planned. They remind readers that conditions can change and they don't commit to updating these predictions unless it's legally required. And to wrap things up with the documents, we have the exhibits. These are the actual legal papers that back up everything in the report. We've got the original indenture from 2018, the new supplemental indenture from September 2025, and the form of the actual notes. Plus, there's the legal opinion and consent from their lawyers. Now, let's put on our investor hats. This filing tells us Simmons First National Corporation is actively managing its debt. They're issuing new debt to pay off older debt, which is generally a sign of a company trying to optimize its financial structure. The fact that they're paying off $330 million of older notes with $325 million of newer notes suggests they're either getting better interest rates on this new debt, or they're reducing the overall principal amount they owe, or possibly a combination of both. The 6.25% fixed rate for the first 5 years is a known cost, but the floating rate after that introduces some uncertainty. If interest rates rise significantly, their interest expenses will go up, which could impact their profitability. However, banks are generally adept at managing interest rate risk. The subordination and structural subordination of these notes mean that in a severe downturn, these investors are the last to get paid after depositors and other creditors. This is why they typically command a higher interest rate than more senior debt. From a broad perspective, Simmons First National Corporation seems to be taking proactive steps to manage its finances and capital structure. They are raising capital in a way that allows them to meet their obligations and potentially improve their cost of funding. The critical factor to watch will be how they manage the transition to the floating rate period and whether they remain compliant with the Federal Reserve's capital regulations. So what's my take on Simmons First National Corporation based on this filing? They appear to be a reasonably well-managed company that is diligently handling its debt. They're raising capital efficiently to refinance existing obligations. The key strengths are their proactive approach to financial management and their ability to secure funding. A notable risk, as always with floating rate debt, is the potential for rising interest rates to increase their costs. Also, the subordinate rate debt is the potential for rising interest rates to increase their costs. Also, the subordinate and structural subordination nature of this debt means that in a crisis, those investors bear more risk. However, for a bank, this is a fairly standard and expected way to manage capital. The key strengths are their proactive approach to financial management and their ability to secure funding. A notable risk, as always with floating rate debt, is the potential for rising interest rates to increase their costs. Also, the subordinate and structural subordination nature of this debt means that in a crisis, those investors bear more risk. However, for a bank, this is a... What do you think about Simmons First National Corporation's latest financial maneuver? Does the move to refinance their debt make sense to you? Let us know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and make sure to subscribe to Corporate Decoder for more in-depth financial analyses. And hey, join our Discord community linked in the description for more discussions and insights. Thanks for watching, and we'll see you in the next one.